Hi, I'm Tor from Pro Stock Tips, and in this video I'll be explaining why I believe the stock market is due for a bounce. So first of all, I'll start with the US stock market, so the S&P 500 and the Nasdaq. So first of all, it's had a sharp drop down, so it could be due for a technical bounce. And also, I believe the inflation readings will begin to trend down. Now, the reason why I say this is because the US dollar has appreciated, or at least the DXY index, by 10% since February or so. So that's quite a substantial rise in the DXY, and I believe this will result in lower cost of imports, and the lower cost of imports could translate into lower prices in the US, which could result in a lower perceived risk of an aggressive Fed tightening policy. So therefore, investors or the market may be more likely to believe that the Fed will be less aggressive with their tightening policy, which is one of the key reasons behind the stock market sell-off in the first place. Also, the stronger DXY should result in improved earnings in the retail sector, as obviously many of these retailers that import products to the US and then sell them, will benefit from the strong dollar. So that could include Macy's, Target, Gap, Bbby. I'm sure there's many others. In the past, I've covered Macy's and Gap, as well as Bbby. So I certainly believe there's some opportunities there. Bbby being most risky. And a side effect, though, is weaker exports. If the price of the US dollar is strong, that may weaken the US exports, which may in turn weaken the GDP and employment figures, which could then, result in less aggressive Fed tightening, which would probably be more beneficial to the stock market than the effects of the weakness in the GDP and employment figures. Okay, and also the next thing is a potential catalyst, which could result in an increase in the share prices of some of the tech stocks. So, example, Amazon is performing a stock split. So, target date for that is the 6th of June, in which case the share price will move from around $200 to $100. So, this will seem like a bargain, right? Potentially investors will seize this opportunity and buy Amazon shares now that they're $100. Obviously, the valuation hasn't changed, but as we saw with Apple and Tesla, when they did their splits both before and after, we saw substantial improvements in the share price. Now, there's the Fed meeting, which is scheduled for around the 15th, 16th of June. So if there is a bounce in the stock market, you may want to get out maybe a week or something ahead of that meeting, as obviously prior and after the previous Fed meetings, where they hiked rates. Sorry about that. We saw, a sharp drop off in the stock market. So that could be a concern around that time, unless they say something positive, like that they're being less aggressive with their policy. We also have some buyback opportunities. So Apple is performing something like a $90 billion buyback. So that's quite substantial in terms of buyback sizes, and could be supportive of the Apple share price. Obviously, Apple and Amazon, for example, make up significant portions or weightings of the indexes. And you've also got Google and Meta with their buyback programs. Meta obviously buying back their shares at a very low price now, multi-year lows. So potentially, if they were to continue to spend, say, $30 billion a year on buybacks at these low prices, that the low share price would be unsustainable, as they would continuously shrink their stock by, say, 7% a year. So that could be quite substantial. And a lot of investors may be starting to see attractive valuations in a lot of these beaten down tech stocks, as well as potentially some short covering. So we could see some rise in valuations. We did see on Friday, certainly some sharp moves to the upside. And now over to the ASX, which is the primary market I like to focus on. And first of all, that high US dollar correspondingly has resulted in a weak Australian dollar. So this weakness in the Australian dollar to 68, 69 cents actually kind of makes up for the fall in commodity prices that we've seen in, say, iron ore and copper, because obviously it's quite a substantial devaluation of the Australian dollar versus, say, the US dollar. And materials do in fact make up a significant portion of the index. So a weak Australian dollar is very good for the materials sector, which is currently quite low right now after a bit of a sell-off. So I believe that weak Australian dollar could result in strength in the materials sector, which is the second largest sector on the index. Now, you also have, with these strong earnings that we're seeing due to commodity prices and in the materials sector, should translate to strong dividends potentially in September. For example, BHP, should post quite a strong dividend this year, I would expect. And that's also another key catalyst, is the BHP demerger, which is targeted for the 1st of June. So that's with Woodside. They'll distribute their Woodside shares to shareholders. And I believe that in advance of that, people might bid up the BHP share price in order to obtain those Woodside shares. And also post-merger, it could potentially improve the multiples of the stock, valuation multiples, that is, like earnings multiples, as more ESG conscious investors may invest in BHP or assign it a higher valuation now that it's spun off its polluting carbon industry, their petroleum industry, to Woodside. And Woodside, on the other hand, is benefiting strongly from the high oil and gas prices. So potentially we could see improvement in the share prices of both Woodside and BHP. And obviously also the COVID situation in China, with Shanghai starting to reopen, could potentially be very bullish for the Australian stock market if they do get their COVID situation under control, as obviously China is a significant trading partner with Australia, and also is responsible for buying the bulk of our primary exports, like iron ore, for example. So thanks for watching, guys, and that is my forecast. Keep in mind that my forecast may or may not be accurate. So anyway, thank you for watching.